Face of the worst inflation in the U.S. in 40 years.
Right? We are in a serious inflationary environment.
The Federal Reserve is raising interest rates.
The Bank of Canada is raising its overnight lending rate by 75 basis points up to a much more restrictive 3.25%. That is going to ripple through the variable rate mortgage market.
Rising interest rate and inflation is one of the hottest topics that is being discussed globally around the world. Post-pandemic, every economy is facing this problem and every country is increasing its interest rate to tackle the inflation. What is inflation and what it has to do with interest rate? We will go into detail today to find out. Inflation is the average rate at which prices increase in an economy. Cup of coffee was costing 25 cents in 1970 and same cup is costing $1.85 in today's market. The increase in coffee price is a result of inflation. Inflation is a cause of concern for everybody nowadays because it is affecting me, it is affecting you, and it is affecting a country itself, and it is affecting the global economy right now. Now the question arises, why the inflation exists? Inflation is a vital part of an economy in capitalist world. Like in mechanical moving system, friction is a necessary evil. Similarly, inflation is a necessary evil in an economy. It drives the people to work. That results in more production. More production means more GDP of a country, and more GDP means nation is getting prosperous.
Inflation is only good up to a certain extent. The governments of a countries try to keep the inflation within 2 to 2.5% range because, as it is rightly said, excess of everything is bad. Too much inflation can have dangerous consequences. It is not good for healthy economies. That's why government try to control it through different tools of their central banks.
If I give you $5 today and I tell you to spend it, otherwise tomorrow it has no worth, you will spend it today. That is basically what the banks are doing. They are creating inflation and saying the money is getting devalued over the period of time so they can spend it. They basically are instructing the people not to hold the money, because if people hold the money, economy will slow down. Eventually a country will run into recession. In COVID-19 pandemic, that is exactly what happened. Because the supply was limited and money was more, governments give $2,000 here in Canada in the form of Canada Emergency Response Benefit. In US, they give stimulus checks. So people had more money, they were spending more. Supply was limited because production was halted, ships were not moving, there was a supply chain bottleneck. So basically that contributed to higher inflation. What this has to do with the interest rates? We'll try to understand that, but before we establish the connection of inflation and interest rate, let's first understand the central bank. The central bank of a country, unlike other banks of the country, is not profit driven. We can say the central bank is the bank of the banks. In Canada, we call the central bank as the Bank of Canada. In US, they call the Federal Reserve, and every country has their own central bank. The job of the central bank is to make sure that banks are operating under certain rules and regulations so that there is no inflation. Instead, they work with the government to make sure the economy runs smooth of a country. So interest rates are one of the strings that central bank pull to stimulate the economy or slow down the economy. Now when there is too much inflation, that means there is too much money available in the economy but the limited supply, that is causing the inflation. What the central bank does, that they increase the interest rate most commonly to tackle the inflation, because what happens when they increase the interest rates, basically they are instructing the other banks that are profit driven to limit the supply of money. So basically they are pulling the money out of economy so that things are not getting that expensive. That is why when inflation increases, every time the central banks start increasing the interest rate, they are pulling the money out of the economy so that the things start getting cheaper. Now, governments cannot keep this operations going on with the interest rate increments, but eventually what they are doing is to control the economy so that The inflation is smooth. I hope today's video was useful. If you like it, please consider subscribing the channel. Thank you so much.